I want you to get together.
Now you've found your home. How best to pay for it, really? Obviously, you're getting a mortgage, you have to pay it back, unfortunately, and that involves basically picking a strategy that will help you reduce the amount of total interest that you pay, but at the same time allow you to live a life without putting a noose around your head, with having to commit to mortgage repayments that just aren't feasible. So, ultimately, the goal in buying a mortgage, in my view, is to how to reduce the total interest that you're going to pay. I'm going to give you a quick overview of the different type of rates that are available, and then we'll get into the specifics around strategies. Okay, there's two types of rates. There's a variable rate and a fixed rate. Variable rate, basically, as it would suggest, can go up or can go down based on what's happening normally in the marketplace, as in what's happening in the rates in Europe and then what's happening with each particular bank. They can change them without any notice, and you literally are at the mercy of the bank, because they can go up or they can go down. Now, the benefit of a variable rate would be if you were anticipating either the rates are going to fall, so that then you haven't stuck to a rate that ultimately is going against you. Or with variable rates, it gives you greater flexibility. If you felt you were going to come into some money that you wanted to pay off your mortgage in a quicker time frame, being on a variable rate allows you to do that much easier. Ultimately, you can make overpayments easier with the variable rate. So there is definite advantages to taking a variable rate. Obviously, there is the risk, though, obviously, of the rates going up and the rates going against you, which will obviously increase your mortgage repayments. But you can always choose to fix a mortgage at any point when you're on a variable rate. Fixed rates, well, ultimately, they can be, as I said, they're fixed, and they can be fixed for whatever period of time that you choose. You're normally given choices of fixed rates between 1, 3, 5, 10. There's now one bank that's actually offering up to 20-year fixed rate. It's literally there's only one bank, and it's very much a new departure out there. Value of a fixed rate is obviously, well, security. You know you can budget. If rates are going up, you're not going to be affected. Disadvantages with fixed rates, well, you may not be able to overpay as much as you would like, as you might be able to make big lump sum payments. Some banks will allow you to pay a certain percentage off the mortgage if you're taking a fixed rate, but it's difficult to clear the mortgage in one fell swoop if you're on a fixed rate. Okay, so that's a kind of a summary of both variable and fixed rates. And there's no right or wrong answer. That's like, you do need a crystal ball to kind of predict what's going to happen in the rate. A lot of that will boil down to your own personal preferences and your own personal set of circumstances. Just kind of very strongly aligned to that is the concept of cashback. Does it make sense? Okay. Now, I'm going to introduce you to a brilliant website called Carl's Mortgage Calculator. Bear with me. And I'm going to, okay, you can see this here now. It's Carl's Mortgage Calculator. What I have done, just as a working example, I have taken someone a property 350, borrowing 315, and taking an interest rate, a typical interest rate with cashback of 2.8%, and I've taken the term of 30 years. If you basically look at that, your repayments on that would be about $1,294 per month. Okay, now reduce that rate to a non-cashback kind of rate. You might be able to get 2.3%. So you're looking at 1,294. Now it's becoming 1,212. That's about 294. I'm just doing my maths in my head. It's about €80 per month more expensive with the cashback mortgage. So if you take that over a year, that's €960 per month more expensive with the cashback. But if you do that, say, take over 3 years, that's basically almost 3,000 in extra payments. But if you get the cashback, you're after getting 6,200 up front. So by taking a 3-year view or a shorter view with the cashback, you actually have saved yourself over €3,000. However, if you were not to move your mortgage and you were to stay with the bank that gave the cash back, right, you'll see without the cash back, this is just a rough example, but at that rate, the total interest you'd pay in the mortgage would be 121,000. If we go back to the cashback mortgage at 2.8%, well, there's an extra 30,000 up to 151,000 in total interest that you would pay. So really, my view on this is very simple. If you're going to take a sort of a 3-year view on your mortgages, then you would review it and then you would move to a different lender after the 3 years. Well, then the cashback makes sense. Okay, but if you want to take a longer term view, and a mortgage is a longer term instrument, but then the cashback doesn't make sense. Now, by taking the shorter term view, the risk that would be subject to you would be, well, if something happened to your income, you weren't able to move your mortgage, or if there was a crash in the market and the prices were to fall, then you wouldn't be able to move, and you'd be stuck with the bank that's paying you that you're paying the higher interest on. So literally a personal preference. Obviously, in some instances, if there's a shortage of available funds for the deposit, the cashback, or to help with furnishing and afterwards, the cashback can be a very, very good option. But again, keep in mind the risk that's associated with it. Okay, so again, personal preference, but keeping in mind all the different factors. The next thing that I want to just, while we're on this, or while we're here, of a similar concept, is the term of the mortgage. Okay, ultimately, the quicker you can pay the mortgage back, the less total interest you're going to pay. So I'm just going to show you this mortgage here is at 30 years. Your total interest is 151,000. Okay, but if you reduce that down to 25 years, well, you're only paying total interest of 123,000 over. So that's a huge saving in interest. But obviously, your monthly repayments have gone up from about 1220, I think it was, or 1280 to 1460. So you need to keep in mind, well, living your life as well, so that you don't have a sort of you're not making a commitment that you can't keep. Okay, so listen, this is a great website for actually really getting forensic in terms of looking at what the total interest, because ultimately the cost of the mortgage isn't the mortgage you're taking, it's the mortgage and the interest that you're paying. And the quicker you can pay it back, ultimately the less interest you will ultimately pay on the mortgage. So let's go back. So again, overpaying your mortgage is of a similar concept, which will ultimately help reduce the term and which will ultimately help reduce the interest that you pay. Just one caveat to all this: if you're buying a new property, well, ultimately what I would suggest is, like, this will be reviewed. You'd make a decision at the time when you're getting a loan offer, but with a new property that could take 6 to 9 months to be built, you'd review it again kind of 2 to 3 months out from the closing date to make sure that circumstances in the market haven't changed and there isn't a better option out there for you. So I hope that helps with your understanding. As I said, the Carl Mortgage Calculator is a great place to really get forensic with it. But obviously I'm still here as well to answer any of the questions that you may have. And look forward to talking to you soon. I want you to get together.